Caterpillar's second quarter did not read like a traditional heavy machinery report. Revenue reached a record $20.5 billion, up 24% year over year. Adjusted profit per share was $8.17, up 73%, well ahead of expectations. And the growth was broad. All three primary segments grew double digits. Construction up 35%, resource industries up 20%, and power and energy up 17%. The more striking number is the order book. Backlog rose $9 billion in a single quarter to a record $72 billion, with all three segments contributing. What is driving this is no longer just the construction and mining cycle. There is a new source of demand, data center power. Inside the power and energy segment, sales of power generation to end users grew roughly 72%, the company said it plainly. Sales of large reciprocating engines and turbines increased, primarily in data center applications. The logic is simple. The capital that the tech giants are pouring into AI ultimately lands in data centers, and data centers need enormous, reliable power. When the grid is not enough and interconnection is too slow, projects turn to on-site generation and backup power, and Caterpillar's engines and turbines are the supply. On the compute side, the market watches NVIDIA and AMD. On the networking side, it watches Arista. On the power side, Caterpillar is the overlooked beneficiary. AI needs compute, compute needs power, and power needs equipment. To meet the demand, the company is resuming production of a 10-megawatt medium-speed gas engine, ramping toward about 1.5 gigawatts, folded into a 65-gigawatt capacity ambition for 2030. That explains where the analysts focused. All 5 questions on the call circled the same issue: whether this data center power demand holds up beyond 2027. Bank of America asked whether Caterpillar is more or less confident in that 65-gigawatt target. Melius noted that some power providers are already booked into 2029 or sold out, and asked whether Caterpillar is full for 2027 and 2028 as well. Management held its confidence in the target and stressed that the backlog growth was broad, not just a few large awards. 2 other threads are worth noting. One is aftermarket. Baird asked how large the service and parts business inside power and energy is, and whether it scales with the backlog. The other is rental. Wells Fargo pointed to dealers planning to double their rental fleets over 5 years. Both are how a one-time equipment sale converts into recurring, durable cash flow. Management also gave full-year guidance. It raised the revenue growth outlook to the mid to high teens. It expects full-year tariff costs of about $2.2 billion at the low end of the prior range. And it now expects machinery, energy, and transportation free cash flow in the top half of its $6 to $15 billion target range. There are things to temper the headline. This quarter's operating profit included about $392 million in tariff recoveries. Excluding that, the company guided full-year adjusted operating margin to near the bottom of its target range. The quarter's margin was lifted by a one-time item. The company also reorganized its segments this period, from energy and transportation to power and energy, which reduces year-over-year comparability. Stepping back, Caterpillar has added a second identity. It remains the cyclical heavy machinery company it has always been, but in the AI infrastructure wave, it is now also a supplier of power equipment. How far that role goes depends on whether this data center demand is a few years of pull forward or the start of a decade. 3 months from now, the Q3 report is the first check. Watch 4 things. First, whether the record $72 billion backlog converts to recognized revenue on schedule. Second, whether the data center-related power orders continue or peak. Third, how large the net tariff impact is once the recoveries fade. Fourth, whether the aftermarket and rental businesses scale with the backlog. When those 4 land, Caterpillar's AI power story is confirmed.